Inflation, the silent killer. What is inflation? Why is it up, and whom does it hurt? How can you save your wealth during inflationary time? Hi, and welcome to another episode of Knowledge Unlimited, where today we will answer those questions about inflation, the silent killer. Inflation is back and might be here to stay. After more than 30 years where we managed to keep the inflationary forces at bay through ever-expanding energy supply and cheap Asian labor, it is back, seemingly to stay. Vladimir Putin might have pulled the trigger, but the gun was loaded and the powder was dry. Inflation is now at its highest level since 1982, but understanding why is a story of many causes. Inflation is a loss of purchasing power over time. It means your dollar will not go as far tomorrow as it did today. Inflation is typically expressed as the annual change in prices for a basket of goods and services. In the United States, there are two main inflation gauges. One, the Consumer Price Index, or CPI, measures the cost of things urban consumers buy out of pocket. The other, the Personal Consumption Expenditures Index, or PCE, is released at more of a lag and measures things people consume, including things they do not pay for directly, notably healthcare, which insurance and government benefits help to cover. The two indexes are also built slightly differently. The Federal Reserve, America's central bank and the institution in charge of keeping prices from increasing too rapidly, targets 2% annual increases in the PCE index on average over time. A little bit of consumer price inflation is generally viewed as desirable, in part because it gives companies room to adjust to a changing economy, one where labor and commodities might cost more without being forced out of business. In the short term, inflation may be caused by a so-called hot economy, which is another word of saying tight labor market. If the unemployment rate is low, then labor is hard to come by, and companies bid against each other for workers, making wages rise. If wages rise, then aggregated demand in society increases, as people have more money to spend, thus buys more goods and services, which in turn make businesses able to raise price, causing higher prices, which is the definition of inflation. But inflation can, and often does, rise and fall based on developments that have little to do with fundamental economic conditions. Limited oil production can make gas expensive. Supply chain problems can keep goods in short supply, pushing up prices. The skyrocketing inflation the world has experienced this year has been driven partly by demand increases and partly by special issues. On the issues side, the COVID pandemic has caused factories to shut down and has clogged shipping routes, helping to limit the supply of cars and couches and pushing prices higher. China has locked down Shanghai for an extended period of time, which has exacerbated the supply chain issues again. Airfares and rates for hotel rooms have rebounded after dropping in the depths of the pandemic. Gas prices have also contributed to heavy gains recently. While Putin's war hasn't helped, the gas prices have also increased massively due to lack of investment from big oil in the past 10 years. Big oil have been hit by so-called ESG standards in the financing business, making their financing expensive, which have partially made reinvestment into new production low. But inflation is also rising since consumers, who collectively built up big savings thanks to months in lockdown and repeated government stimulus checks, are spending robustly. And their demand is driving part of inflation. They are continuing to buy even as costs for exercise equipment or outdoor furniture rise, and they are shouldering increases in rent and home prices. The indefatigable shopping is helping to keep price increases brisk. High or unpredictable inflation that isn't outmatched by wage gains can be especially hard to shoulder for poor people, simply because they have less wiggle room. Poor households spend a bigger chunk of their budgets on necessities, food, housing, and especially gas, which is often a contributor to bouts of high inflation, and less on discretionary expenditures. If rich households face high inflation and their wages do not keep up, they may have to cut back on vacations or dining out. A poor family may be forced to cut back on essentials like food. Really high inflation typically spells trouble for stocks. Financial assets in general have historically fared badly during inflation booms, while real assets like houses have better held their value. The reason is simple. You need to make higher returns to break even. While it might have been attractive to invest money for a 3% annual payback before an inflationary burst, once inflation has taken off to 4%, your investment would actually be declining in terms of real-world purchasing power. Plus, inflation can be tough on the underlying business. Companies that lack pricing power, meaning that they cannot easily pass costs on to customers, suffer the worst because they are forced to absorb input cost increases by taking a hit to their profit margin. High inflation can also spur the Federal Reserve to increase interest rates as it tries to cool off the economy and slow demand. If the central bank does so drastically, it could even plunge the economy into a recession, which would also be bad for stocks, along with everything else. So, where do you invest your money in inflationary times? The first option is TIPS, Treasury Inflation Protected Securities. TIPS are government bonds that mirror the rise and fall of inflation. So when inflation goes up, the interest rate paid does too. And when deflation occurs, interest rates fall. Because TIPS are backed by the US federal government, they're one of the safest investments for your money and an effective way to diversify your investments while also supplementing future retirement income. While stocks may fall during inflationary times, commodity stocks typically perform very well during inflation. If the price of labor, services, and capital increases, then commodities increase with them. Oil, gas, metals, and agricultural companies are safe investments in that case. If you really want to be a purist, you can actually buy futures or the products directly. Also, gold is popular as an inflation hedge. While gold doesn't always protect against rising inflation in the short term, it tends to keep up over the long term, meaning decades for the patient investor. Real estate also traditionally does well during periods of higher inflation, as the value of property can increase. This means your landlord can charge you more for rent, which in turn increases their income, so it is on pace with the rising inflation. And there you have it. There are no easy solutions when the silent killer comes knocking, but if you stay alert, you might be able to defend yourself going forward. To make sure you don't miss our episode on capital allocation next week, subscribe to our channel. Thank you for watching this quick update from Knowledge Unlimited.